$74 billion gone. And Enron employees were told to buy more stock. That alone tells you almost everything about this collapse. Because by the time employees were being told to stay confident, the people at the top already knew the company was in serious trouble. Enron looked like one of the strongest companies in America. It was praised as innovative. It was praised as fast-growing. It was praised as the future. Investors loved it. Analysts respected it. Employees believed in it. And that is what made the collapse so devastating. This was not a company that looked weak. It looked powerful. That is the first lesson of Enron. The biggest collapses usually do not look dangerous from the outside. They look impressive, look polished. They look unstoppable. And Enron looked exactly like that. In the 1990s, Enron transformed itself into a massive energy trading company. It was no longer just about pipelines or selling energy in the old-fashioned way. It became a company tied to complex financial deals, trading, projections, and aggressive expansion. That story was exciting to Wall Street. A company that was modern. A company that was sophisticated. A company that seemed smarter than everyone else. And the market rewarded it. Stock price rose. Its reputation grew. Its executives became stars. But under the surface, there was a problem. Actually, there were many problems. Some business units were not performing well. Some investments were losing money. Debt was building. The real economics were far weaker than the public image suggested. At that point, Enron had a choice. It could slow down. It could admit weakness. It could report disappointing numbers and deal with the consequences. But that is not what happened. Instead, Enron moved toward concealment. This is where the collapse becomes more than a business mistake. This is where it becomes deception. The company used complex accounting structures to hide debt and make performance look stronger than it really was. One of the biggest tools in that process was the use of special purpose entities. These were separate legal structures that allowed Enron to move liabilities away from its main balance sheet. That matters because investors rely on the balance sheet to understand the financial health of a company. If debt is hidden somewhere else, the company can appear much healthier than it really is. So, on paper, Enron looked cleaner. On paper, it looked more profitable. On paper, it looked more stable. But the underlying risk had not disappeared. It had only been moved out of sight. And that is one of the most important ideas in financial collapse. Hidden risk is still risk. Just because the public cannot see it does not mean it is gone. In fact, hidden risk is often more dangerous because people continue acting with confidence while the real danger keeps building underneath them. That is exactly what happened here. Enron kept reporting strong results. The market kept believing the story. Employees kept believing the company was strong. And at the top, the executives understood far more than everyone else. They knew the business was fragile. They knew the accounting was masking reality. They knew the company depended on confidence continuing. That confidence was everything. Because once a company becomes dependent on perception instead of real strength, any crack in trust becomes dangerous. And eventually, the cracks started to appear. Analysts and journalists began asking harder questions. Some financial disclosures were too complicated. Some transactions did not make economic sense. Some of the structures looked engineered more to shape appearances than to reflect reality. That is another lesson from Enron. When a company becomes too difficult to understand, that is not always sophistication. Sometimes it is camouflage. Complexity can be used to impress people, but it can also be used to hide what simpler reporting would reveal immediately. As outside scrutiny increased, confidence began to weaken. And once confidence weakens, the entire machine starts shaking. Investors start asking whether the profits are real. Creditors start asking whether the debt is manageable. Employees start worrying whether the future is safe. The stock starts to fall. The pressure rises, and the truth gets harder to hide. This is the point where many collapses accelerate, not because the underlying weakness is brand new, but because people are finally starting to see what was already there. That is what happened with Enron. As more truth came out, the market reacted. The stock price fell sharply. What had once traded above $90 per share collapsed toward zero. That was catastrophic for investors. But it was especially catastrophic for employees, because many employees were not just earning a paycheck from Enron. They were deeply financially tied to it. Their retirement savings were invested in company stock. Their financial future was connected to the success of the business. And many of them trusted what leadership was telling them. That trust was fatal, because while employees were being reassured, top executives were selling shares. That fact is one of the reasons Enron still hits so hard emotionally. This was not just a bad strategy. This was not just a misread market. This was not just an unlucky downturn. This was a situation where ordinary workers trusted the system they were serving, while the people with the most information protected themselves first. So when the collapse finally happened, the damage was not abstract. It was personal. Savings disappeared. Retirement plans were destroyed. Years of work lost value almost overnight. That is why Enron became more than a business story. It became a symbol of corporate deception, a symbol of broken trust, a symbol of what happens when image becomes more important than truth. In December 2001, Enron filed for bankruptcy. At the time, it was one of the biggest corporate bankruptcies in American history. The fallout was enormous. Executives were investigated. Court cases followed. Some senior leaders were convicted. But even that did not undo the damage. Because when retirement savings are wiped out, when careers are shattered, and when people discover they were misled for years, there is no simple repair. The money does not magically come back. The lost years do not return. The trust does not easily rebuild. This is why Enron still matters. It matters because it shows how collapse really works. It does not usually begin with one dramatic explosion. It begins with smaller compromises. A number adjusted here. A disclosure hidden there. A structure created to keep the story looking clean. A leadership team deciding that preserving the image matters more than telling the truth. And over time, those decisions stack. The company starts serving the illusion. The market rewards the illusion. People build their lives around the illusion. Then one day, reality arrives. And when reality arrives after years of concealment, it does not tap gently. It hits all at once. That is Enron, a company that looked elite, a company that looked modern, a company that looked unstoppable. But underneath all of that was debt, distortion, and deception. And once the truth broke through, the entire thing collapsed. That is why Enron is still one of the clearest examples of corporate failure in history. Not just because of the money, not just because of the accounting, but because of the betrayal. Employees trusted leadership. Investors trusted the numbers. The public trusted the image. And that trust was abused. So the next time a company looks too perfect, remember Enron. If the growth looks unbelievably smooth, look closer. If the story sounds too clean, look closer. If complexity keeps replacing clarity, look closer. Because sometimes the biggest companies are hiding the biggest lies. And when those lies finally break, they do not fall quietly. They take people down with them. This was a $74 billion lie. And the people who trusted it paid the price. If you want to understand how these collapses really happen, watch the next breakdown.